Swayam Prabha. Digital India. Educated India.
We will start with the topic time value of money in real estate now as part of the course Real Estate Finance and Investment Strategies. So, first table of content. So, here you can see that we will be covering foundation, what is time value of money, why it matters in real estate. We will also go into some basic concepts, present value, future value, discounting, compounding. Then we will see the practical applications in part 2, where we will be talking about real estate investment analysis, mortgage and financing decisions, Indian market examples. We will be then covering in part 3 advanced concepts such as NPV and IRR analysis, risk and sensitivity analysis, behavioral considerations, and then in part 4 we have real world implementations. We will see certain technology tools. We have common mistakes which we have to avoid, and certain key takeaways from this overall session. So, now the question is, would you rather have option A of 10 lakh today or option B of 10 lakh after 5 years? Okay. So, I will repeat this: option 1 10 lakhs today, option B 10 lakhs after 5 years. Most people choose option A, but what is the reason behind it? Right? What is the reason behind choosing of option A? So, I hope you will think about it. Before seeing the answer, you can think about the reasons. So, the answer is that your instinct to choose money today over money in the future is absolutely correct, and there are 4 key reasons why. First, there is a earning potential. So, if you have 10 lakh today, you can invest it in fixed deposit, mutual fund or real estate and earn returns. Even at modest 8% annual return, your 10 lakh would grow to 14.7 lakhs in 5 years. Second, inflation impact. So, due to rising prices, 10 lakh today can buy more goods and services than 10 lakh will be able to buy 5 years from now. If inflation is 5% annually, items costing 10 lakh today will cost 12.8 lakhs in 5 years. Third, the risk factor. Future payments are uncertain. There is always a possibility that the promised future payment might not materialize due to various circumstances. Finally, and most important for this course, real estate decisions involve large amount of money over extended periods. Whether you are buying a home, investing in commercial property or developing a project, understanding time value helps you make the optimal financial decisions. Okay. So, moving on to present value, the foundational concepts we will be understanding now. So, present value answer the question, what is the future money worth in today's terms? The formula is beautifully simple. Present value equals future value divided by 1 plus the interest rate. So, here you can see the formula. So, let me illustrate this with a Mumbai property example. Suppose you expect to receive 50 lakhs from selling property after 4 years, and you required return is 12% annually. Using our formula, PV equals 50 lakhs divided by 1.12 raised to the power of 4, which equals to 50 lakhs divided by 1.5735, giving us 31.78 lakhs. This means that receiving 50 lakhs after 4 years is equivalent to receiving 31.78 lakhs today, assuming you can earn 12% annually on alternative investment. Now, this is a powerful concept. It allows us to compare money received at different times on equal basis. So, if someone offers to sell you the rights to that future 50 lakh payment for say example 35 lakh rupees today, and you have just estimated that it is 31.78 in today's term, if you, because you have other options available, always alternative investment options are available. So, will you still buy that option of 50 lakhs for 35 lakhs today when you know that the value is 31.78 lakhs? The answer is of course no, and in that case you will not go with that offer, right. Then moving on to step by step calculations of what we just did, and you can see that the calculations are very straightforward, just simple arithmetic of formula, and we can get this value of 31.78 lakhs. But this information which we received is very powerful, that we can help in taking the right decision about the investment option. Then moving on to the future value concept. So, future value is the flip side. It tells us what today's money will be worth in the future. The formula is present value multiplied by 1 plus the interest rate raised to the power of time period. Now, consider a Bangalore investment scenario. You have 25 lakhs to invest today and you expect 8% annually for 7 years. Now, using this formula, FV equals 25 lakh multiplied by 1.08 raised to the power 7, which equals to 25 lakhs multiplied by 1.7138, giving us 42.8, around 42.87 lakhs. So, this means your 25 lakh investment will grow to nearly 43 lakhs, generating additional wealth of 17.87 lakhs through the power of compounding. This is why starting early in real estate investment is so powerful. Time literally helps you make money grow. The longer your investment horizon, the more dramatic the compounding effect becomes, right. So, this is the step by step calculation. Again, we can see that the calculation is very straightforward. Application of this formula arithmetically, we can then deduce the future value, just like we did for the present value. We can use this formula for future value, reverse of that. So, that is there. Then we come to compounding. We just mentioned the power of compounding. So, let me show you why Einstein allegedly called compound interest the eighth wonder of the world. Now, this table compares simple interest versus compound interest on 10 lakh rupees at 10% annual rate over 20 years. So, with simple interest, you earn 1 lakh each year, totaling 30 lakhs after 20 years. But with compound interest, your earning accelerate each year because you earn return on both your original investment and previous earning. After 20 years, you have 67.27 lakhs. That's 37.27 lakhs more than the simple interest. So, you can clearly see the power of compounding here with this example, right. So, in real estate, this compounding effect works through rental income, reinvestment and property appreciation. So, if you buy a rental property and reinvest the rental income into more properties, or if the property value appreciates at compound rates, your wealth grows exponentially rather than linearly. So, you can understand that how you are applying this to real estate. Now, this is why successful real estate investors focus on long term wealth building rather than quick profits. Here you can see the compounding calculation. You can see that how we have gained through this, and in year 1 we earn 1 lakh for our 10 lakh investment, but in year 2 we have earned 1.1 lakh because we are now earning interest on 11 lakhs total. By year 3 our interest jumps to 1.21 lakh because our base has grown to 12.1 lakh. So, clearly you can see that how money is increasing in terms of compounding. Now, we come to another important concept of discounting. So, discounting is the process of calculating present value, and selecting the right discount rate is crucial. Think of the discount rate as the minimum return you are required to compensate for risk and time. A typical real estate discount rate has 4 components. First, the risk free rate, currently around 7% based on government bond yields. This can also be sometimes taken as deposit rates of banks. So, there can be different thought process behind it, but government bonds again safest. So, risk free rate currently around 7%, that is there. Then we have real estate market risk premium of about 3%, because real estate is riskier than government bonds. Then third, property specific risk of 2% for factors like location, tenant quality and property condition. Finally, a liquidity premium of 1%, because real estate is less liquid than stocks or bonds. So, this gives us a total discount rate of 13%. However, this rate should be adjusted based on specific circumstances. Prime Mumbai properties might warrant 10 to 11%, while development projects in the tier 2 cities might require 15 to 18%. The key is being realistic about the risk and ensuring your discount rate reflect actual market conditions, right. Then we take one example here of Chennai office building. So, let us analyze a concrete investment opportunity. The asking price here is 2 crores, right. The building currently generates 24 lakhs in annual rent, which we expect to grow at 5% annually. Operating expenses are 6 lakhs, growing at 3% annually. We plan to hold the property for 8 years and sell it for 3.5 crores. Our required return is 12%. This is a typical investment scenario that requires TVM analysis. We need to project cash flow, calculate present value and determine if this investment creates value. The key here is being systematic and realistic in our assumption while applying TVM and principles rigorously. So, first we will take a cash flow projection. So, here our 8-year cash flow projection, in year 1 rental income is 24 lakhs minus 6 lakhs in the expenses, giving us 18 lakhs net cash flow. Each subsequent year rental income grows by 5%, while expenses grow by 3%, gradually improving our net cash flow. By year 8th year, you can see that we are round about above 7 lakhs, and we can see that net operating cash flows are around 27 lakhs, and we are receiving around this is the rental income we are earning. So, this kind of projection we have made of cash flow. Now, notice how the growing income stream creates increasing cash flow over time. This is typical in well located commercial properties where rental escalation outpaces expense growth. The key is making realistic assumption about growth rates based on market research and comparable properties. So, now we go to the cash flow growth calculations. So, understanding how to project growing cash flow is essential for real estate analysis. Properties typically experience rental growth and expense inflation at different rates. For rental income, we use the compound growth formula. Year 1 rate is our base of 24 lakhs. Year 2 rent is 24 lakh times 1.05 to the first power, giving us 25.2 lakh. Then year 3 continues this pattern, 24 lakhs 1.05 square times. So, it is 26.46 lakhs, and by year 8 we calculate 24 lakhs 1 times 1.05 to the 7th power, resulting 33.77 lakhs. So, this represents a 41% increase over 8-year period. Operating expenses follow the same logic, but with different growth rate. Starting at 6 lakhs and growing at 3% annually, expenses reach 7.38 lakhs by year 8. Notice that the rent grows faster than expenses, improving our net cash flow over time. This differential is crucial for successful real estate investment. Now, we have NPV calculations. Now, comes the crucial NPV calculation. We discount each year's cash flow to present value using our 12% discount rate. Present value of all operating cash flows over 8 years total 1.46 crores. The present value of proceed is then calculated, right. So, our total present value is 2.87 crores compared to the initial investment of 2 crores. This gives us a NPV of around 87 lakhs, a positive result that suggests this is a good investment. A positive NPV means the investment creates value above our required 12% return. In simple terms, we are getting 2.87 crores worth of value for a 2 crore investment. This 87 lakh positive NPV represent the additional wealth this investment will create beyond our minimum return requirement. So, that is the concept of NPV, net present value. So, now let us take a step by step calculation. So, this detailed NPV calculation shows how we convert each year's cash flow to present value. The discount factor decrease each year because money received further in the future is worth less today. So, year 1's discount factor is 1 divided by 1.12, which equals to 0.8929. This means 1 rupee received in year 1 is worth about 89 paisa today. Years 2 factor drops to 0.7972 and so on. Multiplying each year cash flow by its discount factor gives us the present value. So, year 1's 18 lakh becomes 16.07 lakhs in today's money. Year 2 19.02 lakh becomes 15.15. The sale proceeds then requires special attention. 3.5 crore received in year 8 has a discounting factor of 0.4039, giving us present value of 1.41 crore. Summing all these present value minus 1.46 crores from operational plus 1.41 crores from sale gives us 2.87 crores total present value. Subtracting our 2 crores investment yield a NPV of 87 lakhs, confirming this is a value creating investment. Okay, then we move to another example of home loan EMI calculation. So, TVM, that is your time value of money, equally important in mortgage calculations. Consider a Delhi home purchase with 75 lakhs, loan at 9% annual interest rate for 20 years, right. To calculate the monthly EMI, we use the payment formula with a monthly interest rate of 0.75%. The formula consider that each payment includes both principal interest with the interest portion decreasing over time as the principal balance reduces. Our calculation shows EMI of 67,462 rupee per month, right. So, understanding this calculation helps us evaluate different loan option. For instance, a 15-year loan would have higher monthly payment but significantly lower total interest. A 25-year loan would have lower monthly payment but much higher total interest. So, TVM analysis help us choose the optimal loan structure based on financial situation and opportunity cost we have. Okay. So, then we can see the step by step EMI calculation here. So, EMI calculation, we start with our loan amount of 75 lakhs, interest of rate of 0.75% and 240 total payments we are making. So, the EMI formula accounts for the fact that each payment includes both principal and interest with the interest portion decreasing over time. Step 1 requires calculating 1.0075 raised to the power 2 40th power, which equals to 6.0226. This factor represents the total growth of money over the loan period. Step 2 calculates the numerator. Our monthly rate times this growth factor gives us 0.0517, and then step 3 we have finds the denominator 6.0226 minus 1 equals to 5.0226. Finally, we multiply our principal by the ratio of the numerator to denominator 75 lakh times 0.008994, which gives us 67,462 rupees. So, this EMI remains constant throughout the loan, but the composition changes. Early payment are mostly interest, while later payment reduce more principal. Understanding this helps with refinancing decision and loan term optimization. Then we move on to TVM, whether rent or buy analysis. Okay. So, here one of the most common application of TVM, rent versus buy, we can see, considering example of or case of Pune IT professional with a 80 lakh apartment and option, basically that is option right now. Buying requires 20 lakhs down payment and 53,000 around monthly EMI, plus we have 8,000 property tax and maintenance. Then alternatively, there is a rent option for 25,000 monthly, escalating at 5% annually, and investing the 20 lakh down payment at 8% return. What option creates more wealth over 10-year period, that we have to know. This decision involves multiple cash flow at different times, making TVM analysis essential. We need to calculate the present value of all cost and benefit for each option, including opportunity cost and tax implications. So, the complete analysis we can now go through. So, for the buy option, we are analyzing an 80 lakh property with standard financing term, 25% down payment, 9% interest rate and 20-year amortization, transaction cost of 3% including stamp duty, right, and registration and legal fees, cost often overlooked in simplified analysis. These are some assumptions we are making, right. So, these are assumptions on which our calculations are based. Then monthly maintenance of 8,000 rupees escalating at 4% annually, then reflecting that reflect the realistic upkeep cost. Then property appreciation of 6% annually aligned with the long term Indian real estate trends in tier 1 cities. And then for rent option 25,000 monthly rent with 5% annual installation is market realistic. The 8% investment return assumes equity mutual fund or similar instrument with 30% tax reducing effective return to 5.6%, right. So, our 10% discount rate reflects the opportunity cost of capital for a middle class professional. The 10-year analysis period provides meaningful comparison while remaining realistic for career and family planning horizon. Now, let us go into buy option. So, initial cost total 22.4 lakhs, 20 lakhs down payment plus 2.4 lakhs in transaction cost, right. This immediate outlays represent the opportunity cost we must evaluate against alternatives. Monthly EMI of 53,997 continuing, right, for 120 months during our analysis period. Total EMI payment reaches 64.8 lakhs, but we must around 64.8 lakhs, but we must remember that part of this reduces our loan principal. Maintenance cost here start at 8,000 rupees monthly, right, but escalates annually. By year 10 monthly maintenance reaches about 11,800 rupees, right. The total maintenance over 10 years is sum to approximately 11.5 lakh rupees, right. So, that we have calculated the total cost of both of earning and of the maintenance cost total. Then property appreciation is crucial to the analysis. Starting value of 80 lakh grows at 6% annually, reaching 1.43 crores after 10 years, right. So, after 10 years, after deducting 2% selling, net proceeds are around 1.4 crores. However, we still owe money on the mortgage after 10 years of payment, our remaining loan balance is approximately 36.8 lakhs. This balance must be subtracted from sale proceeds to determine our net equity position. So, we now go to rent option, we analyze that also. So, the rent option involves two primary components, rental payment and investment opportunity analysis. Rental payment begins at 25,000 monthly but escalates annually. Year 2 increases to 26,250 rupees, year 3 to 27,563 and so forth. By year 10 monthly reaches to 38,773 rupees, a 55% increase over the decade. Total rent payment over 10 years is some approximately to 37.8 lakhs. However, for fair comparison, we must calculate the present value of these payment using our 10% discount rate. Okay. So, investment component assumes we invest the 22.4 lakhs that we would have gone towards down payment and transaction cost, right. So, at 8% gross return, this investment at 8% gross return, this investment grows to about 48.4 lakhs over 10 years. However, we must account for taxes on investment gain. So, assuming 30% tax on capital gain reduces our effective return to 5%, 5.6% annually. This after tax investment grows to approximately 38.5 lakh, representing 16.1 lakh in real gain. The opportunity cost of choosing rent over investment is this foregone investment growth, which must be included in our total cost analysis. So, now here the whole breakup of the calculation is provided. Now, we can convert basically all cash flow to present value for accurate comparison. This step is crucial because money received or paid at different times cannot be directly compared. So, for the buy option, we calculate present value of each component. Initial cost of 22.4 lakhs are already in present value. EMI payment requires the present value of annuity formula, 53,997 rupees monthly for 120 months at 10% annual discount rate gives us 40.86 lakhs present value. Maintenance cost escalating at 4% annually, but discount at 10% have a present value of, gives us a present value of around 7.49 lakhs, right. So, total cost present value reaches 70.75 lakhs. Property sale provides a major benefit. 1.4 crore received in year 10 discounted at 10% equals 54.1 lakh present value. Net cost for buying 70.75 lakh minus 54.1 lakhs equals to 16.65 lakhs. So, for the rent option, escalating rental payment have a present value of 25.42 lakhs using the growing annuity formula. The investment opportunity foregone, the returns we miss by not investing 22.4 lakh has potential value of 13.23 lakhs. So, total rent option cost 25.42 plus 13.23 equals to 38.65 lakhs. Comparing the two of buying of cost, comparing the two options, buying and selling, buying and renting, buying cost is 16.65 lakhs versus renting 38.65 lakhs, making buying superior by 22 lakhs in present value terms. So, this is something we can understand that we are. Then moving on, we have NPV versus IRR. Now, NPV and IRR are the dynamic duo of investment analysis, each providing different but complementary insights. NPV gives you the absolute value creation in rupee terms, how much wealth the investment adds to your portfolio. IRR gives you the percentage return earned, making it easy to compare with other investments. NPV accounts for project size. So, a large investment with same IRR will have higher NPV. IRR is scale independent, making it perfect for comparing investment of different sizes. So, both metrics should generally give the same except reject decision for independent projects. But we will have a fixed rule here, we can make a simple rule here. The decision rule is simple: accept project with positive NPV and IRR above your required return. When choosing between mutually exclusive projects, NPV is generally preferred because it measures absolute value creation, right. Then we move on to an example here. So, let us calculate IRR for a Gurgaon retail space investment. We invest 1.2 crores initially and receive cash flow of 15 lakhs, then 16.5, then 18 lakhs and finally 19.5 lakh plus 1.4 crore from sale in fourth year. So, if your required return is less than 17.3%, accept this investment, right. If your required return is higher, reject it. IRR is particularly useful when communicating with investor or partners because percentage return are easily understood and compared with other opportunities. So, here you can see that what we are doing, we are calculating this. If it is okay, if our required return is lesser than this, then it is acceptable. Otherwise, so this kind of yardstick we can follow, simple percentage, and that is something which can investor class can be take a quick decision of whether to go with the investment or not. Now, how we come about this? So, what is the calculation process? So, here we can see IRR calculation requires trial and error unless you use financial software. So, financial softwares can help in this regard, but otherwise it is a trial and error method. So, let me demonstrate this process to help you understand what IRR really represents. So, IRR is the discount rate that makes NPV equal to 0, right. It is discounting us, bringing it to 0. So, we try different rates until we find the one where present value of inflow exactly equals the outflow. So, let us start with 15%. So, negative 120 for the initial investment plus 15 divided by negative 120 initially for the investment plus divided by 15 divided by 1.5 plus 16.5 divided by 1.5 squared and so forth, right. So, this gives us NPV of positive 8.51 lakh, meaning 15% is too low, right. Then we move to 20%, try that. The same calculation yields negative 0.857 lakhs, right. So, the true IRR lies between these rates. So, somewhere between 15% to 20%, that we have now found out. So, using interpolation, we can use the interpolation or Excel IRR function, we can find the precise answer, and that is 17.3%. That is the 17.3%. So, this means the investment generates exactly 17.3% annual return over 4-year period. So, IRR is particularly useful for comparing investments of different sizes and time horizon. So, if you require return is less than 17.3%, accept this investment. If your required return exceeds 17.3%, reject it and find alternative with higher return. But you will see that this is a very good method to find out whether you want to go with the investment or not. So, something which is very quick and handy for investor class, that they can quickly decide on a particular project, compare different options and then decide whether they want to go with a particular option or not. So, in that way IRR can be very useful. Now, we go for sensitivity analysis. So, what is this? So, real estate projections involve uncertainty, making sensitivity analysis crucial, right? So, we test how changes in key variables affect our investment returns. The four most important variables are rental growth rate, right? Property appreciation, right? Then we have vacancy rates, and then we have exit cap rates of plus 1%. So, these are some key variables we want to test. Now, using our Mumbai project example, the base case NPV is 87 lakhs, but if the rental growth drops by 2%, NPV falls to 52 lakhs. So, if the exit cap rate increase by 1% point, NPV drops to 49 lakhs, right. So, most sensitive to exit assumption that we can clearly see. So, if exit cap rate increase by 1% point, NPV drops to 49 lakhs. What is this telling us? So, this analysis which we have done reveals that our investment is more sensitive to exit assumptions. Therefore, we should spend extra time researching likely cap rates 8 years from now and perhaps be more conservative in our estimate. So, sensitivity analysis identify the key risk and focus our attention on the most critical assumption. Okay. So, here we can see this sensitivity table quantifies how changes in key assumptions affect investment value. This analysis is crucial because real estate projection involves uncertainty. Our base case NPV of 86.9 lakhs assumes specific growth rates and exit condition. But what if these assumptions prove wrong, right? So, sensitivity analysis answers this question systematically. Rental growth changes have significant impact. So, reducing rental growth by 2% point drops NPV to 52.3 lakhs, a 40% decline. Conversely, increasing rental growth by 2 points boost NPV to 121.5 lakhs. This 80 percentage point swings demonstrates the importance of realistic rental projection. Property appreciation changes show similar magnitude. A 3 percentage point increase in appreciation improves NPV by 27%, and while a decrease of the same magnitude reduces NPV by 27%. More dramatically, exit cap rates changes create the largest NPV swings. Increasing the cap rate by just 1 percentage point reduces NPV by 44%, while decreasing it by 1 point improves NPV by 44%. Right. So, this 88 percentage point total swing highlights exit assumption as the critical factor. So, from minus 44 to 40 plus 44, there is a 88 percentage swing, which shows that exit assumption is very critical. Okay. Then let us see the behavioral biases or the psychology behind this TVM decisions. Now, the first one, which is our anchoring bias. So, 4 common biases are there. The first one is anchoring bias. Anchoring bias is basically which causes us to fixate on a asking price or initial valuation, preventing objective analysis, right. So, this is something that I have decided that okay, this is something which I think is the right price. Maybe I bought it at this level. I was informed by somebody that this is the right price, you should be going for your property, and then sticking to that particular value in the mind, and then assuming that is the right decision and that is the right price, we stick with that particular value. That kind of anchoring which we do, that creates a bias. So, that is one of that. Then there is overconfidence. So, overconfidence leads to overly optimistic projection about rental growth, appreciation, or our ability to time markets. Loss aversion makes us hold losing properties too long, hoping to break even rather than cutting losses and redeploying capital. So, overconfidence in our projections. We have just seen that small changes in our rent projection can lead to drastic uh, uh, you know impact on our final conclusions on NPV, IRR. And when we are making these assumptions, they should be realistic. Okay. So, when we make realistic assumptions, when we are not overconfident, we are realistic in our scenarios, in our projections, they are based on some uh, proper information, trends which are there in the market, then we get the right output, and we are able to make better decisions. So, overconfidence, one more type of bias. Then we have the herd mentality. So, herd mentality is something that we decide what is being decided by most of the people in the market. We are following a trend. We are following most, how other participants in the market are doing. So, this generally impacts us most during the peak boom times and the most, uh, you know, uh, down bust times, because at the topmost level of the boom market, for example, when the dot-com bubble was about to burst, or in 2008 the economic recession, at the peak of that, when there was lot of confidence in everyone, even though it was clear that the the market sentiment and the realities of the economies are not matching, but still because of that herd mentality, many people took wrong decision. So, such type of herd mentality also can play in making the wrong projections. And then loss aversion also, we discussed that it makes us hold losing properties too long, hoping to break even rather than cutting losses. And we have discussed this in the first session also, that there is this tendency, especially in retail, in the retail, with the retail investors or with the small investors or residential investors, that they want to stick to a particular price and they do not want to sell below what they have paid for a property. So, this kind of also plays into the biases of TVM decisions, and proper analysis is clouded by these type of errors which we make due to emotions. Then coming to TVM in Indian real estate context. So, Indian real estate has unique characteristics that affect TVM analysis. RERA compliance adds cost to development projects and affect cash flow timing through escrow requirements. GST impacts under construction property purchases differently than ready properties. Capital gain tax with indexation benefits affect exit decisions and net returns. Cultural factors also also matter, and joint family decision making can complicate discount rate selection, and emotional attachment to ancestral properties may override financial analysis. So, a lot of emotions, you can clearly see that there is lot of emotions which is dictating the decisions. Then typical discount rates vary by market. Prime Mumbai and Delhi properties might warrant 10 to 12%, whereas tier 2 cities require 12 to 15%, and development projects need 15 to 20% to compensate for higher risk. So, discounting, how the discounting is done, and understanding these local factor is crucial for accurate TVM analysis in the Indian context. Then moving on to how we can use technology for better TVM analysis. So, modern technology makes TVM analysis accessible to everyone. Excel has built-in function for all major calculations. So, use equal to PV for for present value, equal FV for future value, equal NPV for net present value, and IRR for internal rate of return calculation. So, we can use these calculations in Excel, makes our process much more easier in comparison to the formulas we saw. Instead of going for that trial and error, we can use Excel for our calculations. Then we also have option of using professional softwares like we have this Argus Enterprise, very good for commercial real estate analysis, while real data works well for residential investments. Property metrics offer excellent portfolio analysis capabilities, and for quick calculation, mobile apps like Financial Calculator Plus, they also work very good. Okay, so there are different type of these softwares. Then we move to some mistakes which we can make in this analysis of time value of money, and let's see how we can avoid them. So, first mistake we have mixing nominal and real rates. That mistake we can do. So, avoid so if your cash flow include inflation, use nominal discount rates. If cash flows are real, use real discount rate. So, that is a simple thing which we have to remember. Second, always include transaction cost, right, like stamp duty, registration fees, and brokerage in your analysis. Third, resist the temptation to use overly optimistic growth assumptions without market justification, right, and adjust discount rates. Fourth one, adjust discount rate for different property types and location. Don't use the same rate for prime Mumbai office and emerging market residential properties. Fifth, be realistic about terminal value assumption considering property age and market condition at exit time. Each of these mistakes can lead to poor investment decisions. The key is being conservative, realistic, and comprehensive in your analysis, right. Then what are the best practices which we can follow for the success in TVM? So, it's better to be pleasantly surprised than disappointed. Always perform sensitivity analysis to understand key risk and variables. You can understand that a small variation, small change in assumption can make big impact. So, be conservative, be not very aggressive, because that will give you pleasant surprise, and that is better than instead of making big mistakes in your analysis. Then include all cost in your analysis, not just the obvious one. Regularly update your models with actual performance data to improve future accuracy. Don't hesitate to seek professional advice for large investments. Cost of expertise is usually far less than the cost of mistakes. We have just elaborately discussed that what kind of mistakes we can make in assumptions, what biases are there. Sometimes we are emotionally attached to our properties, and in that moment we make projections. We might make projections that are not very realistic, that are not very true to accurate market realities. In such scenarios, in such conditions, it is always better to stick with expert guidance, because property investment, property selling buying involves lakhs or crores of rupees, and that is why it must be taken very prudently. right? So, we then go to quick decision framework which we can make. Here we have this 5-step framework. First, identify all cash flows and their timing, include income, expenses, capital expenditures, taxes and sale proceeds. Then second, determine the appropriate discount rate based on risk free rate plus risk premiums for the specific property and markets. Third, calculate NPV and IRR using projected cash flows and discount rate. Fourth, perform sensitivity analysis on quantitative analysis while considering qualitative factors. This systematic approach ensures you don't miss important considerations and make your decisions more consistent and reliable, right? Then let's take one illustrative example. So here we are talking about a Bangalore techie, a person who is a Bangalore IT professional with 50 lakhs to invest in 2019, evaluating 3 options using TBM principles. Option A, Whitefield apartment with an NPV of 8.5 lakhs. Option B, with option B was electronic city villa with an NPV of 12.2 lakhs. Option C was a commercial space with an NPV of 18.7 lakhs. So, despite an emotional preference for the villa, that person chose option C based on TVM analysis, right? By 2024, the property value had grown from 50 lakhs to 85 lakhs, generating 7.2 lakhs in annual rental income. The actual IRR of 19.4 exceeds the projection, the projected 18.2%. So, the projection was of 18.2%, but the actual IRR was 19.4%. This example illustrates how TVM analysis can help overcome emotional biases and led to better investment outcomes. The key is trusting your analysis and maintaining financial discipline. So, this is just one example, but of course, if NPV, IRR techniques, if the time value of money is properly analyzed, then in that case the outcomes can be very beneficial to us. So, keeping aside emotions, proper assumptions can lead to success in investment of real estate by following these principles. So, the key takeaways, what are the key takeaways that we can do? Money today is greater than money tomorrow. Time value is fundamental to all decisions. NPV and IRR your best friends. So, use them judiciously, make assumptions judiciously. Sensitivity analysis is very crucial. Small changes can lead to significant errors. So, making assumptions correctly, very important. We discussed a problem and saw that how small changes were impacting the outcome. Beware of behavioral biases. We have seen different type of biases like anchoring bias, like following the crowd, following the herd. These type of things should be avoided. Emotions should be kept aside while taking this decision. If it is not possible, taking help of professional is not wrong. Consider Indian market specifics. We should always remember what are the regulations, what are the taxes, what are the cultural factors playing out, because that plays very crucial role. So, real estate is context dependent, local market factors very much play there. So, all this should be kept in mind, and these are the key takeaways from here. So, how we can master in real estate? Timing is everything, and TVM helps us to time everything right. Present and future value calculations can help, NPV IRR analysis can help, mortgage and financing evaluation, risk and sensitivity assessment, behavioral bias awareness. These are our toolkits. When we use these tools wisely, we can feel that real investment always have a positive NPV. So, that is the positive note on which we should end this session, and hopefully this will help you take the right decision and understand the concept of NPV and IRR. Thank you so much.